Here is the scenario we're working with. Here's our timeline. This is the month of August. On August 1st, we began our period with, 20 units at $91 each. So those are purchases that happened in the previous month that went unsold and rolled over to the current month. So $91 times 20 is $18.20. And then on August 3rd, we have a purchase, 15 units at $106 each for a total of $15.90. We have our first sale on August 7th. We've sold, 20 units, 5 times 4, 20 units for $130 each for total revenue of $2,600. And then we're back to purchase. On August 17th, we bought 20 units at $115 each. Another sale, August 20th, we sold 15 units at $140 each. $2,100 is our total revenue. Another purchase on August 25th, 15 units at $125 each for a total of $1,875. Our last purchase, just 5 units at $119 each, $595. And then we've got our final sale. On August 30th, it is 25 units, big sale, 25 units at $150 each. So that is $3,750 of revenue. So here's our timeline that we're going to be working with in this problem. This is Perpetual LIFO. Before we begin, let's look at the cost flow. Beginning inventory, we're going to look at it units first. Beginning inventory is what we began the period with, those 20 units at $91 each. Those are from purchases from the previous period that went unsold and carried over to the current period. So that's beginning inventory, 20 units, plus what we bought. 15 units here on August 3rd, August 17, another 20 units, so that's 35 units. Another 15 units on August 25th, so that's 50 units, and another 5 units on August 28th, so 55 units. We bought 55 units. It means the total amount that we had available for sale is the 20 and the 55, or 75 units. Those 75 units were either sold or they remain unsold. So we can look at our sales. We've got 20 units here, plus 15 units there, that's 35 units sold, plus another 25 units here, that's 60 units sold. So if we sold 60 of the 75 units, there's only 15 remaining in ending inventory. You do the same thing for the dollars. Our beginning inventory cost us $18.20. Our purchases cost us $15.90 plus $2,300 plus $1,875 plus $595, $63.60. The sum of those two numbers is the cost of the units that we had available to sell to our customers during the entire month of August, $81.80. That $81.80 cost is either going to go to ending inventory or cost of goods sold. We need to apply one of the inventory methods in order to figure that out. So here we're going to do Perpetual LIFO. The Perpetual system says every time we make a sale, we're going to do the journal entry. Every time we make a sale, we're going to do the journal entry. So here's our first sale on August 7th. The LIFO method says when we make a sale and we're looking for the costs associated with that sale, we're going to start with the most recent, the last in, the most recent purchase, and work our way away from the sale date. So sale date of August 7th, most recent is August 3rd. If we need more, we're going to go to August 1st. This is a sale of 20 units. So we need all 15 of these units and 5 of these units. So there are the 20 units, the revenue, and the cost. So let's write that journal entry. Whenever we have a merchandiser making a sale, there are 2 journal entries that we need to write. We need to write the revenue journal entry. So that is, let's say this is a cash sale. So that is cash for the sales amount, $2,600. And then a credit to sales for the same $2,600. This is going to happen on the sale date of August 7th. We need to write our second journal entry, and that is a debit to cost of goods sold, to record the cost of the goods that we just sold. It's an expense account that we're increasing, that's why we're debiting it. And that is the costs of the 20 units that we grabbed here. So 5 units at $91 each, plus the $1,590. $2,045. And the credit is merchandise inventory for $2,045. What we're doing with that credit is we have sold these units. They no longer belong to us. They now belong to our customer. So we need to pull them out of the asset account. They're no longer our asset. Pull them out of the asset account called merchandise inventory. We do that with a credit. And we're going to move them over to the expense account called cost of goods sold. So it can be reported on the income statement as the cost associated with the sale. We move to our next sale. And that happens on August 20th. We sold 15 units. 15 units on August 20th. So LIFO says we start with the most recent acquisition and work our way to the oldest. So we're going to take some or all of these, and if we need more, then we're going to move over here. What was it again? 15. We only need 15. So we're going to take 15 of that. There we go. So now we've got the 15 units that we sold and the cost associated with those 15 units. So we can write our journal entry. We got 2 of them. First, the revenue journal entry. Assume this is a cash sale for the revenue amount of $2,100. And then credit sales for the same $2,100. 15 units at $140 each. And then our cost, the second journal entry, is our cost entry. We're going to record this on August 20th, the date of the sale. Our second journal entry is a debit to cost of goods sold for the cost amount. The cost amount is 15 units at $115 each. 15 times 115. $1,725 is how much that sale cost us. How much the merchandise that we sold cost us. Our credit is merchandise inventory for the same 1725. So there's the second journal entry for the August 20th sale. And we've got one more sale here on August 30th. We are applying the LIFO method, which says we grab the most recent acquisitions and work our way this way. So you can see how this LIFO method can be a little weird, because if we only sold 5 units on August 30th, we would take these and put it over here. And what we would end up with is some of the August 25th units in ending inventory, and some of the August 17th units in ending inventory, and some of the August 1st units in ending inventory. But let's see what happens. Oh, there's a big one. 25 units is what we sold. 5 by 5. 25 units at $150 each is what we sold. So let's calculate the cost associated with that. We need to get 25 units, the cost for 25 units. Here's the first 5 right there. I took it from here, 5. And here's another 15. So 5 and 15 is 20. So I keep going. I'm moving away from the date of the sale. And I grab another 5 here. There's 25. So here is here's the details for that third sale. We can record the journal entry. We record the revenue piece, $37.50 is a debit to cash and a credit to sales for $37.50. And this is on August 30th, the date of the sale. And now our second journal entry is for the cost piece. We're going to debit cost of goods sold for the cost amount. We got a few pieces here. Did I cut any of these? No, I only cut that one. So we've got 5 times $115. This is $575 plus this is $1875 plus this is $595. $30.45 is our cost. And the offset is merchandise inventory. $30.45. So there's that third journal entry. And now we can finish this off. We look at what remains. And I got to be careful. These are the costs for this. The only thing that remains is way back here. This one's going to roll over to next month. It's 15 units at $91 each. 15 units at $91 each. $13.65 is the cost in ending inventory. Our available for sale cost is $81.80 minus $13.65. Oh, try that again. $81.80 minus $13.65. $68.15 is backing into the cost of goods sold. But I'm going to calculate that the right way. And the way we do that is we just look at all of our cost of goods sold pieces here in the 3 journal entries we wrote. That one plus that one plus that one will give us our cost of goods sold. So let's see, 2045 plus 1725 plus 3045, 6815, 6815. We finished the cost flow. We wrote all the journal entries for the sales. And those are the journal entries that we made for the purchases when they happened. A debit to merchandise inventory and a credit to cash in the amounts of all those purchases. That's what got those costs into merchandise inventory. And here is where we took those costs out of merchandise inventory when we sold them. That's perpetual LIFO.